defining flight to quality. And I'll start with some actual definitions here. Flight to quality gets tossed around a lot, can be used as a noun or an adjective a ton of different ways. One of those terms that can mean so much and mean, as we'll see here in a second, maybe nothing at all. But how I would define it is the act of selling risk on to buy risk off assets. That's often done with vigor in times of economic stress. When the stock market is kind of humming along, drifting positively like we saw in 2017, 2018, 2019, flight to quality doesn't get brought up very much. Of course, there are flight to quality assets, the adjective there, an asset considered less risky than stocks that could increase in value during uncertain times. Those flight to quality assets like bonds and gold are always around, but in relatively stable times, like I say, 17, 18, 19, they don't get brought up so much because they're just kind of trading in what I would deem no man's land, bouncing around as stocks drift higher. But when you see economic stress or uncertain times, which usually is correlated to stocks moving lower, that's when flight to quality assets start showing up more in your Twitter feed and in Google search, news items, everything else, and they tend to be rallying. There is a flight to quality from those risk-on assets like stocks that are maybe moving lower because of economic stress or uncertain times. That's what this looks like here. Go back to the pandemic's start in early 2020 as news is coming out late Feb, early March of that year. 10-year notes, or what? Of course, here's a quick aside: 2-year, 5-year, 10-year Treasury notes, 30-year Treasury bond. Let's all just call them bonds. It's the bond market at this point. But bonds rallying as the pandemic news is coming out. Gold saw a little whiplash back and forth there, but ended up rallying as the pandemic news comes out throughout the spring and summer of 2020. And this is what I would call is probably our most recent flight to quality, genuine flight to quality. The stock market falls in February and March of that year. Times are very, very uncertain. It's pretty much all we heard for that year in 2020 is uncertain times. And that coincided with 10-year notes and the bond market at large rallying, causing interest rates to fall. Keep in mind that interest rates and bond prices are inversely measured. So everybody's looking to buy up these safe assets, this government debt, these treasury notes and bonds. And as they're buying them up, the prices are moving higher and rates are moving lower. And that makes sense, right? I really just want something stable, something safe. And so I'll buy this thing regardless of what the interest rate is. And so that supply and demand shifts there as the flight to quality pours into the bond market. People are willing to take lower and lower interest rates. And gold doesn't even bear interest. It's a non-interest bearing asset, but people in those the stressful times, uncertain times, are like, man, I'll bury my money in this gold here that isn't liable to movements in the economy at large or a region's currency or what have you. It's just deemed as this safe haven asset. And then as more stuff comes out, we start to speak to solutions to this pandemic. It's, the effect of it is lessening throughout the later part of 2020 and 2021 there. These flight to quality assets start to fall in price. There's not as much demand for them, right? And their prices lower there. Now, here's the interesting thing, though. You would expect to see this flight to quality. Part of the definition there is I'm selling my risk-on assets. I'm selling my stocks and my crude oils, whatever is deemed risky there, or not necessarily risky, but what is intended to do well when people are feeling good and the economy is prospering, a risk-on asset there. You would expect, coinciding with this chart, a mirror image of stocks falling and staying low and then starting to rally back in the latter part of 2020 and the early part of 2021. As I bring stocks in, though, what's really interesting is that they start rallying back in the spring of 2020. By summer of 2020 here, stocks are getting ready to make new all-time highs again. They're ready to eclipse their prices of pre-pandemic there. And gold and bonds are actually making highs. You can see almost in the middle of this graphic, highs in 10-year notes and gold around August, September of 2020. And the stock market around the same time is, like I say, eclipsing those pre-pandemic prices. And so as economic fear is subsiding, if you were just looking at the flight to quality assets, you would have thought that hadn't occurred until 2021, but stocks, at least, are telling you that fear is subsiding actually much earlier than that. And so this becomes a situation of like, is one of these wrong, or is this situation a little bit more nuanced than we thought? And of course, nothing is ever wrong. The market is efficient, and it's going to shift almost continuously as news and other things come out. But it is weird that our flight to quality markets aren't subsiding directly with fear in the stock market. And you essentially have an environment there for the second half of 2020 where flight to quality and their antithesis, risk on markets, are all making new highs. Kind of some weird action there. And of course, if you dig into what was going on there, you would find, well, one, of course, bond markets are staying high. The Fed at that time was talking about how they're going to keep interest rates low until we're really out of the woods with the pandemic. And gold is starting to kind of get, honestly, ahead of some of the potential inflation worries, I would say, by staying high. And actually, really, that breakout above $2,000 in gold was a big news story at the time there. And I would guess that since it was happening as stocks were performing well, that was the gold market saying, hey, man, if they're going to keep interest rates low here, and they're doing all this stuff to keep money cheap and flying around as we're all staying inside in the pandemic there, then gold might be ahead of these inflation worries, whatever it was there. But then, of course, you have stocks rallying back because of how quick the Fed and other global central banks were to provide an easy quantitative environment for companies. And then, of course, it just started to set in that, hey, man, maybe staying at home and this cheaper money for companies to borrow is really good for tech stocks, especially, that really took off. I don't want to say as a function of the pandemic, but a lot of that upside was because of the pandemic, especially when you look at stocks like Zoom and Peloton and everything else that have now, of course, subsided a little bit. Anyways, I digress. I want to bring us into the here and now and take a look at what we've been seeing, because this trend that kicked in the middle of 2020, after the pandemic fears are starting to dissipate, has actually really continued. I mean, look at how crazy this is that you have gold, bonds, and the stock market very highly correlated. I mean, these, if I was to take the legend off this chart, I would have, and someone said, hey, Frank, what are these three line graphs? I would be like, oh, man, is that like Apple, Google, and Microsoft? Like, three decently correlated stock markets that are just moving in the same general direction, but to varying degrees. No, this is the same bond market, gold and stock market, stocks and flight to quality falling in 2022 in the same time that you have the S&P 500 falling by 20%. Bonds fall and gold is pretty much unchanged. And so it creates this question again, is one of these markets wrong, or are we not in a true flight to quality environment? Because another interesting piece that a lot of people have called out for the last year of trading is volatility around the stock market. Option premiums aren't really climbing, even though the stock market is down, like I say, 20%, depending on where you're looking here. And it's bounced back a little bit, but amid the sell-off, we didn't see nearly the heights in option premiums and stock implied volatility in 2022 as we did at the outset of the pandemic. And this calls into question this relationship. It's not so simple as selling stocks to buy flight to quality. There needs to be a real sense of fear, of uncertainty. And when stocks are falling for the last year like they have, pretty much as a function of people anticipating higher interest rates and that kind of curbing stock growth, then you wouldn't expect necessarily gold and bonds to be rallying. Of course, higher interest rates from the Fed are quite literally the antithesis of high bond prices. Every time the Fed hikes interest rates, that is coinciding with bond prices, treasury note prices and treasury bill prices usually falling in price. And so that piece is kind of negated. And then gold, again, only really rallies when there's a real sense of like, where are things going? We're really uncertain. We are genuinely fearful. And you saw that rally a little bit in gold. You see there at the start and middle of 2022, when inflation started to uptick and we were like, we don't know where inflation is going. And so where does that leave us with these flight to quality assets? Stocks likely have to fall further for bonds and gold to rally here. I think we would have to see probably another 10 to 20% fall in the S&P 500 for us to see bond prices get back up close to the middle of the range or highs for the last couple of years. Same with gold here, because if stocks just fall another couple percentage points, it's just going to be essentially owing to the higher interest rate environment. And that's known. That's relatively known that our interest rates are going to get a little bit higher and they're going to stay there. Unknown is what really shocks these markets here. And of course, the crux here doesn't necessarily have to be the stock market falling. It could be something that causes the stock market to fall and causes these markets to move, every which way. And I think a lot of people are looking towards inflation for that. Inflation, though it's still a high level fear, got as high as 9% last year and is down to about 6%. If we saw some inflation readings by the middle or end of this year that were 8, 9, 10%, I would, again, expect that flight to quality, especially gold, maybe not so much bonds, would really climb. We don't have that right now. We have a 20% fall in the stock market, but not really coinciding with a genuine unforeseen fear. That's pretty much coinciding with higher rates. And so flight to quality not looking like in very high demand here. But that's the hard game with trading flight to quality is you kind of have to get ahead of this stuff, get ahead of something that's unknown, which is pretty much an oxymoron here to make money off this thing. Because if you are pitching, I'm buying gold or I'm buying bonds because inflation is high. It's like these markets already know inflation is high. Now, the thing would be if inflation gets really high, that's a shock. Or like we saw in 2020, this pandemic comes out of nowhere. Or like we saw in 2007, 2008, this financial crisis comes out of nowhere. That's when you see a genuine flight to quality. Right now, not looking like such. And I think that's a good note to conclude on there is if stocks start to fall and they really start to gain some steam down 5-10%, maybe there's a play in fleeing to that quality, so to speak, before everyone else. But trying to get ahead of something that's unknown, trying to predict an unknown is a very tough game. And that's where you have a lot of talking heads on different financial media speaking to, I think gold's going to 4,000 because of X, Y, and Z. And they usually come off as crazy because that's kind of a crazy thing. But I will leave that there.